I'm going to bring in Kurt Altig here in just a second. Sorry about that. My screen got switched for a second. So we're going to be talking about the housing market. And Kurt's the founder of Builders Capital. And we're really going to dive into some of the things of what we're seeing in the market, what's happening in the market, and why we either believe that it is going to stay strong or where some cracks in the overall real estate market can be. Maybe not just housing, but what's happening in the commercial markets, what's happening on the in the debt markets, which is very important for a lot of people out there, and how Kurt and his company are trying to navigate this process to get back to where they can help a lot of these small and mid-size builders. So I'm going to bring in Kurt here. All right. Kurt, can you hear me?
There. I can. It's going well. Going well.
Yeah,
thanks for having me.
Yeah, you bet. Thanks for coming on. Kurt and I met a few months back, and really talking about the builder market, and it's an area where I focus on and where we're focusing on providing advisory services to a lot of these builders who want to get into the single family and rental space. But this conversation isn't just about that. We're going to cover that market and get some of Kurt's insight, and then some of Kurt's insight of what he's seeing in the debt markets, what he's seeing in the housing market. And first, Kurt, tell us a little bit about yourself, who you are, what you do, why you do it, what your passions are, maybe.
Absolutely. So I'm Kurt Altig. I'm the founder and chairman of Builders Capital. Builders Capital is a specialty finance company. We're based here in Seattle, but have a presence really across the country at this point. Founded the company in 2009. Spent the first, 18 years of my career in the mortgage banking business, building retail and wholesale originations, really around the greater Pacific Northwest area. And from 2001 to 2008, had a couple different roles with First Horizon National Corporation, but the last 4 or 5 of that was leading a residential mortgage division that had a particular focus in the home builder space. And so when the Great Recession descended upon the country, I watched our institution, as well as most of the big credit providers in the home builder space, kind of exit stage left. And that sponsored the idea in me to start a company that was really razor focused on the home builder and addressing the credit need that was in the market. And here we sit 11 years later. And interestingly enough, the need during that time has really only grown. Of course, this coronavirus subsequently descending on the nation as well, or the world for that matter, has caused a fair share of disruption. But we are passionate about really any builder that is not publicly financed in the public markets. Our largest builder will build close to 400 units a year, and all the way down to the local kind of niche specialized builder in the core urban areas. And so that's our target market. We handle projects from really horizontal acquisition, development of lots through vertical construction, and that's our specialty.
And how is that market going now? I mean, it's been tough, right?
Yeah. It's been tough, and it's been really, really interesting. As this thing kind of began to unfold as we came into really the end of the first quarter, the spring market for 2020 was shaping up to be maybe the best. If I just think about, and each market has its nuance, but if I think of all the markets that we lend into across the country, on balance, spring 2020 was shaping up to be probably the strongest we've seen in the last couple of years. I mean, spring of 2018 was extraordinary in the Northwest. But again, on balance, 2020 was shaping up to be fantastic. And, the second half of March, everything came to a screeching halt. And it was pretty scary as we came into early April. But I will tell you, from about the end of the first week in April forward, there has been a steady increase in absorption Again, I'm using kind of a broad brush, and there are different areas around the country that are more affected than others, and some of which we don't blend in. But of the markets that we participate in, it has steadily improved. In many of those markets, sales absorption rates are now at or above 2019. And it would be fair to say that in a handful of the markets that we're in, you literally can't build them fast enough. So the sales activity is really strong. People have adapted to a virtual marketplace, which again, I'm a pretty positive person, but 10 weeks ago, I would not have guessed that so many folks would feel comfortable to buy. And I don't want to say totally sight unseen, because at some point they've got to walk through it, but at least at the front end of the process, going under contract, sight unseen. Here, particularly in Washington, we were one of, I think, 2 or 3 states that locked down really, really tightly.
Right.
For much of, I want to say, April and into the first week of May. You just, unless you were going to the grocery store, the bank, or to see a physician, you were asked to stay in your home. So therefore, virtually no open houses. And when that was unlocked, or people were allowed to move around in early May, again, our market was like it was, shot out of a cannon. And so really, really strong absorption. And so on the sales side, the market has adapted, really, really well.
Yeah, I echo that. I had several transactions that, several transactions that went south in March. I mean, they were set to close beginning of March, into March, beginning of April, and the discount that the sellers all of a sudden were asking were pretty insane. And I honestly thought that was going to be the market we were going to go into, that heavily discounted, a lot of foreclosures. And I just always want to caution, more foreclosures don't necessarily mean more supply. People get that confused. And so I want to definitely be sure to talk about that. But I really thought there's going to be quite a bit of a discount, people not paying rent. And most of the deals that my buyers backed out of, and I'm talking, institutional funds, those properties are no longer available. They've either been sold to a home buyer or they've been sold to a small investor at a much lower cap rate than what the funds were willing to buy in the first place. Right. So we've seen a rush of small investors come in, and they're buying at a 5% cap rate, because they don't look at the cap rate. They look at the cash flow, and they look at the long-term appreciation, and they look at a market and say, well, what's it going to do in 10 or 15 years from now, not what it's going to do next year. And that has pushed out a lot of the funds. And we've even switched our strategy. We're working with a couple of large home builders, and we are marketing the homes to small investors because we're getting a better price.
Right.
We even get a bigger commission. I mean, it's just all across the board. And so I've talked to a lot of builders, and I had to go back to them and say, well, here we go. We're at 20% below what you wanted. And I heard an earful from a lot of people from the fund side going, that's not possible. They're going to have to feel some pain. And then from the builder side going, these people have no idea what's going on. We can't keep the homes in stock. Right. And that was even immediately after they were still, there was all the homes that were under contract that closed on as far as the retail side. And so I think it's because a lot of the, and we talked about this before the call, and I'd love to hear kind of your insight about the distressed fund that you talked to and things like that. But a lot of the people that initially lost their jobs, for sure, were not home buyers. They weren't homeowners. They're not prime borrowers in many senses. So a lot of those people still need a place to live. It doesn't change. And this is where I debate online. And sometimes I get a little out of hand because I see a lot of this false content being put out about how there's a housing crash and everything's going to crash. There is such an undersupply of homes that even if there's a lot of foreclosures, all of those people need a place to live. Right. And it's not like you go from not as many people go from living in a $400,000 house to moving into a government subsidized apartment. It doesn't work that way. They may downsize into a single family rental, for example, whatever it might be. So there is, I have a lot of concern about the people who have been displaced out of their jobs, that there may not be those jobs those jobs may not come back anytime soon. And they were already living in an apartment paying $800 a month or whatever it would be. And now they're displaced. There is going to be a need for more of the government subsidized housing and things like that. That program is already under budgeted. even though the budget did increase, by the way, for those who are interested. It's something that I follow up quite a bit. So there's a lot of need there. But in general, we haven't seen the distress in the housing market yet. And I mean, yet could mean there's no telling what's going to happen. The
Right.
commercial markets are different. You add in COVID and you add in the things that are happening with the rioting. It's getting really scary for some of those areas. But yeah, what do you think? I mean, what's your opinion? Do you think we're kicking the can down the road on the forbearances, and we're gonna see a flood of foreclosures when that stuff ends, and all of a sudden people are gonna stop paying their rent?
It is. I don't know that I am qualified to, answer that much more than probably many of the viewers on this. But I would speak to kind of how we view it. It's hard to argue with the facts that if there has been a V recovery, and time will tell, what the economy does from kind of fundamental data relative to unemployment, GDP, et cetera, kind of the big macro indicators for how the economy is doing. And again, there's a lot of written word and a lot of commentary relative to what that prediction is.
Yep.
With respect to, though, housing, and I would say, at least currently, with respect to the performance in the stock market, it's hard to argue that doesn't look like a V recovery, right? Where we had this sharp downtick in late first quarter, and like I said, in many of the markets that we're in across the country, which is not every market across the country, we are seeing significant pressure on the supply side of the equation, and a lot of transactions now happening. I think it is wise for any operator, be it a builder, a lender, folks participating in this space, to move forward with a different degree of caution than they may have otherwise had at the end of 19, because there's no doubting the fact that there has been unprecedented federal support to try to bridge this gap between when COVID started and when COVID, might end. That can't go on, forever. The debt levels are concerning. The impact on the municipalities that cannot run a deficit like the federal government, that is concerning. And those things are going to come home to roost, at some point.
Right.
And so we did a webinar here recently, and actually I published a video maybe a month ago now on the state of the mortgage market, right? A lot of the great turnover that we're seeing in our portfolio and with successful projects that have come out of the ground and are now being absorbed, in some cases at, again, you can't build them fast enough type of environment. They are at the conforming end of the market. If I was a home builder today looking at putting up speculative builds, or stepping into a major project where I had a lot of infrastructure spend and my time frame was stretched out, I would be thinking very carefully about that. Because again, I think what this market looks like 6, 9, 12 months from now, as some of these federal programs begin to wind down because they have to, and we return to a little bit more of what we would all consider to be normal, I think that it's, again, something to be, really cautious with. And if you can phase a project. If you can repurpose a project to a lower price point and stay away from anything that's non-conforming in terms of loan size to the end buyer, that would be, that would certainly be my advice.
Well, I can give you, and that's great. I agree. I mean, look what's happened in just the last 5 months, or let's just say the last 3 months, with the COVID and with the riots that are happening, and there's this underbelly in our country of what I call a lost society of people who are upset and are rising up, and this all affects everything. And what I can say is, when we're talking to builders, and I spend 90% of my time doing that. I've talked to probably pretty high levels of 8 of the top 10 builders, and every single one of them has said, we're having no problem with sales, but we're not going to keep the same pace we had pre-COVID, even though if we go by what we're seeing now, we should be able to even increase what we had pre-COVID, but we're not going to.
Right.
We're going to kind of just we're going to keep things coasting. We're going to keep things going as they are, but we're not going to put the foot back on the accelerator like we were doing pre-COVID. And that's goes back into the supply issue, right? If you say builders are going to be down about 20 or 25%, you're talking about 1 million homes.
Yeah.
That they will not have built, that they were going to build in 2020. And when we're already undersupplied by, you hear different numbers, 3.5 million at the end of the year, whatever it is now. I've had people throw numbers at me saying we have the same amount of homes as we did it back in 2008, but we have many more people. So you've got to look at everything. But with the population growth, with some people, 75% of the people still have their jobs. There is an undersupply of homes. And so that's on the pricing side. That's what's keeping pricing up. I really see, where I live in Colorado, it's hurting really badly here because they don't know really how to open. So they just opened this weekend. They opened up Airbnb and hotels, and the bookings are at like 8%. When normally they would be at 95%. And so, and if, in a place we're at, if there's 25 new cases, they shut everything back down, which now nobody wants to get tested, which is a whole different thing, right? So like you have all these things happening. So you're going to see certain markets, but even, I have people throw at me the Airbnb markets and how those are hurting all over, and that's going to help with supply. It's just not enough homes to really make a dent in the supply. And they're not all in the right locations, and the Airbnbs typically are not in the affordable home sector. And that's where the need is. But that being said, all of the builders I've talked to are trying to figure out how to do a couple of things. That one is to get into the more affordable space if they weren't in that space in the first place. And the other thing is how to get in front of more SFR funds, small investors that they can piggyback. If they're going to build 100 affordable homes, it's very likely that half of those or more, even in that more affordable entry level, more than 50%, it's going to be closer to 60, 65% of them will be rentals. That's just the way the market is. And that's okay, because people look at like, what's the overall rental for all homes? Well, you take away the upper end of the market, it's really heavily weighed in the entry level home that rentals are. So we've had funds come to us that had a liquidity issue, or they don't want to take the risk where I'm sorry, you have builders come to us that have a liquidity issue and they don't want to take the risk. And you have funds that say, okay, we'll come in when the lot's developed and you're ready to go vertical. We'll come in and fund that whole process.
Right.
And that's going to create a whole separate market of things that are happening. I'm starting to see this happen. I mean, I've spent my other part of my time talking with the funds, underwriting deals and figuring out how they're going to limit their risk, but get in at early enough so the cost basis is low enough, because there's a need for rentals. And so I have a ton of builders. I talk to them all the time. They're like, yeah, we usually are in this 400 plus range. Now we need to be in the below 250, or below 350. How do we do that? And how do we, what do we need to do to get rentals? And so I've even seen a lot of a lot of builders that are going to even rent the homes out and sell them as performing assets because they're going to get a higher price. So things are shifting all over. I have a question for you. If everything as far as the debt markets were lifted and you could lend just like you were lending before, but in this current environment, what kind of risk would you be putting on to the deals? How would you be risking those?
Yeah, we would be focused on a couple of things. We will, and would, in the context of your question, be looking for a lower attachment point. So if prior to COVID, our kind of on the street program, we would go as high as 90% loan to cost. We're going to be more in the 85%. So we're going to be looking for additional capital into the transaction. If on the loan to value side, for construction, kind of 70% had been the standard, you can expect to see, more towards the 85% as far as maximums.
Right.
Project sizes, again, as we think about, we do a fair amount of get involved in the project at the early stages of land development. We'll be looking to phase those projects down to smaller size if and when, available. So there will be flight to quality with respect to probably narrowing that customer set a little bit, I would say, for the more we'll be looking for just better financials, better track records, and probably narrowing that scope for a period of time. And I think on the price point side, as I alluded to earlier, which is consistent with the messaging we've already put out, is really making sure we're spending time with them to think through to the end of the project. Now, you've got a community of 50 homes, just to make up a fictitious example, and the price point focus was going to be 650 as an end unit, or 550. We'll at least be spending time to say, where does that fall within your market in terms of your loan limits? What does your team look like with respect to your mortgage, your sales and marketing focus, and your mortgage focus? We encourage people in our recent webinar that now is probably a time, and I come from that world, and I came from a world where when I had a builder client, or one of my reps had a builder client, we were looking to be that sole source of solution for the takeout. I just don't think, as an operator today, a builder operator, you can afford to have only that type of relationship. You need to cover the market, particularly if you're building a product type where your end unit prices are above the conforming limit.
Right.
And so in markets like Seattle, where trying to stay within the conforming loan limit, which generally speaking is a 765 loan amount, that's really difficult to do. There is a really robust market in kind of that, $1 million to $1.5 million, frankly, depending on, where you're at. So once again, if you're delivering that kind of product, you've got to make sure that you're covering that potential jumbo client, as well as that, of course, that potential conforming client. And with the changes that have happened on the mortgage front, whereas, for example, your biggest jumbo providers, which are the biggest banks in the nation, JP Morgan Chase, Wells Fargo, et cetera, those correspondent channels are now closed off. So where before you could go to your mortgage banker and have them shop that loan with the single loan package to multiple takeout solutions, that buyer needs to now go direct. Or you've got to have a loan officer on your bench that is, a JP Morgan Chase or a Wells Fargo, direct loan officer. So it's just a time to really have a sharpened operation, kind of top to bottom. Builders just can't afford, like they frankly could in probably 2018, 2019, to just build it and they will come. They need to be much more thoughtful all the way through the process.
Yeah, I agree. And that's why we've had people come to us just seeking out, trying to figure out how they can get in that more affordable market, which we're not in the builder space, but we are in a sense because of the funds that are buying that. What was my next question? Well, what are they doing now? So if your typical borrower, if they're not able to, leverage something, one of your products now, or that what you were offering, what are they doing now? I mean, I'm hearing a lot of builders going to some of the community banks and going that route, some going private money route. There's a lot of different people are getting creative.
I would say, again, kind of broadly speaking, what's happened I would say the greatest disruption that we are seeing in the industry right now is in an area of the market that doesn't always get a lot of focus. It's at the capital markets level. This is a non-scientific math equation that I'm about to spring on you, but I would say order of magnitude, I think somewhere between 40 and 50% of the liquidity that was in the market mid-February has exited stage left. The private, and I would say that includes banks, by the way. What's been great about, and there are some fantastic community banks, some of which we enjoy relationships with and have for over a decade now. In each of the markets around the country, there are great community banks that are involved in this is a commercial lending product, even though it's obviously a residential structure in the end, that have been active, in the market, even during the Great Recession. And they continue to be active, in the market. We are hearing, and just recently, as in since probably mid-May, that they are starting to restrict their criteria. They too are looking for, a better, more capitalized borrower. They are restricting starts, whereas they may have been offering speculative starts. They are now not offering speculative start, which is really difficult in a market that's undersupplied. Because as a builder, you don't necessarily want to put that home on the market until it's finished, or you end up setting your pricing 6 months in advance of the market.
Right.
So that's an intense challenge right now for your local, your non-publicly traded builders. I just heard yesterday, and again, want to be careful with this because I certainly have not validated this, that, and I'll leave the bank nameless, but one of the nation's largest banks, we were told by a very accomplished borrower that we have in the Midwest area, that they just were notified yesterday that their line of credit will not be renewed, which comes due in the fall. They did not go so far as to say that they would not fulfill existing, commitments, but this particular company is now going to be out in the market searching for,
right,
had accounted for probably a good 30 to 40% of the capital, the debt capital that they needed. So we still have, and this is impacting everything from bridge loans to fix and flip to new construction. Again, the market that had really matured and formed since, I would say, late 2016, with what's commonly referred to in the market as at the aggregator level, big institutions that routinely buy paper from private companies, which allows them to then recapitalize and go make more loans. That market is totally dysfunctional right now, and for all intent and purposes is closed off. So that leaves a borrower with the option of the nation's largest banks, most of which don't participate in this space, the community banks that have participated, certainly on the construction lending side, not so much on the bridge loan and fix and flip or major renovation product, and the private market. And the private market, again, had been relying on the aggregator market for liquidity. And so that's where the disruption is. And and what will happen is, as capitalism always does, capitalism will see the opportunity and will solve the problem. And companies like Builders Capital will get creative. They'll get back on raising capital, be it from individual investors all the way up to institutional partners. And this too shall pass, but it has certainly been disruptive, in the meantime.
Yeah, because that affects supply, and affects, which affects house prices, which affects, household formation. It affects everything.
Absolutely.
If you had to be a betting man, when do you think this would unstick?
The intelligence that we get, given the partners that we have in space, I predict that the balance of this year is going to continue to be pretty restricted. Again, I think that others that have had an appetite to get into the space and were struggling because they were late to the party, they are now a bit in the catbird seat because they are also not carrying with them big portfolios that they're worried about. That, again, kind of knock on wood, so far so good. But there's this hangover effect in that marketplace by those biggest providers. They're concerned that the credit that stands behind them is not going to be there. And without getting too technical, kind of at the end of February into early March, you saw some failures across the country. A lot of them didn't get, major news. But if you follow the public REIT market at all, most of the big REITs are levered. And they are levered by the likes of Nomura, Credit Suisse, some of the big investment banks. And those credit facilities are referred to as repurchase facilities or repo lines. And the repo lines, the danger of a repurchase line or a repo line is that you get a margin call. And if you get a margin call, you basically have to mark your book to the market. and you have to pay it down, and you're usually talking tens of millions, if not hundreds of millions of dollars. And so right now, that market, that repo market, is frozen, which is causing distress all the way down to the street, because it is effectively, shut off those originators from being able to replenish their capital to go out and make new loans. Now, it is starting to soften just a little bit. And when I say just a little bit, like almost not noticeable, but it is in fact happening. And like I said, I think you'll see some new entrants out into the market. You can expect that leverage ratios are going to be less, and that pricing is going to be higher. So lender margins will go up, lender risk will go down, because because there's a lack of, supply of capital.
Well, and that's the exact reason why I'm having, 3 or 4 calls a day with lenders or with builders who are, all I did was post a couple of posts on LinkedIn saying, hey, you need money, you need to finish your project. I've got somebody that might be interested. And it's funny though, half of it's just, hey, I've got a plot of land we could develop type stuff. But many of it is that people who just need, and they're willing to operate at a very low margin. I mean, they were already operating at pretty low margins. The net margins on a builder is somewhere around 8 or 9%, right? I mean, and they're willing to operate at that margin when you take away a lot of the costs of capital, and now you're only having to deal with the funds cost of capital on the deal. So we're starting to get some deals that can work. Some of it's been a little bit of a reality check for some of these guys, but and that kind of gets into like the commercial markets. And I know we kind of touched on this before, and I used to come from the commercial space, and we're seeing a lot of money, both in the residential and commercial debt, like opportunistic funds that are out there waiting to spend money on distressed assets.
Yeah.
What do you think about that?
Again, if I could be a fortune teller, I'd probably be doing something different than what I'm doing, right? So it's difficult with as much stimulus as is in the market right now to kind of get a sense for what's real footing, right? We've talked a lot about the single family space, and again, I think the balance of the year will continue to be difficult. Well, I would say this: I think until there is a solution for COVID, there's going to be this fear that even if the lack of economic stimulus or that coming out of the market causes disruption, that the other shoe dropping in a fall resurgence of COVID, right, would be the next layer down. So I think until we have a solution, vaccine or otherwise, or great therapy, that's going to continue to impact the debt and equity part of the commercial market that influences the single family market.
Right.
It's interesting. There was a lot of talk in, again, kind of probably late March, early April, these opportunistic funds that were spinning up, and large, 100 million, 200 million, kind of poised and ready to jump on this wave of distress that was coming. And if it was focused on the single family space, that money is still sitting on the sideline. There was a brief opportunity where some folks got caught with portfolios that they otherwise couldn't carry deep into the future, that probably traded at some discount. But otherwise, things have again bounced back. And right now, so far, so good. I think an institution or a lender, for that matter, would be hard pressed to sell, at a deep discount right now, when given enough time, those assets should, if they're finished, should certainly trade. The commercial, if we're talking about other commercial assets relative to retail and or large office, or boy, that is anyone's guess, because I think this crisis of people getting comfortable working from home, businesses adjusting to having their workforce spread out, has hastened the pace of that adoption, right? Companies have just been forced to. I mean, thankfully, we had, by the nature of just our growth across the country in the last couple of years, we had invested pretty heavily in making sure that folks were connected through things like what we're using right now, or Teams or Zoom. And we didn't miss much of a beat operationally in terms of getting, used to that. But I'm sitting in an office by myself right now that's, I don't know, 10,000 square feet. Were my lease up, this year, I would seriously be reconsidering what I absolutely need to have to effectively, run my business. And so I think that we are in for some pretty significant trouble on the commercial real estate front broadly, regardless of how the economy recovers, because I think that we've just hastened the pace to which of the future.
Well, and you can dive into retail and restaurants, and a friend of mine has he just raised a considerable amount of money to buy distressed restaurants, because if you're in destination type locations, you can, if you own the real estate, you're in a much better position than if you're the leaseholder, right? And then if you're the leasee. So, you're seeing a ton of a lot of these smaller towns. I mean, they're getting killed on the restaurant side, on the retail side, and that's stuff that may not come back for a really long time. So it'll be interesting to see how that cohort of workers and entrepreneurs and all of that. And we kind of talked about this before, that the great need for more, there's going to be a bigger need for more subsidized housing, and not just inner city, what people think of a subsidized house, but more suburban subsidized housing. And I've talked about this a lot too. Some of my friends are at the National Neighborhood Stabilization Trust, the National Neighborhood Stabilization Trust. They're trying to put some legislation in to give tax credits to invest in areas that are just these islands of nobody's living there. They're rundown houses, because it costs more to rehab the house or build the house than it does to sell it. So they're trying to push some stuff through and some more things for subsidized housing. But then as there's this flock of people, I don't want to say people are flocking to the smaller areas, but people already before this, I wrote an article in Forbes back in November that was talking about this, how people are already moving to the more affordable areas, and that's been accelerated. Wow. The cities aren't going to go away, but COVID and then the current riots that are happening in the cities, I know a lot of people who are like, you know what, I'm just going to stay at my second home. And if I can't figure that out, then I don't know what I'm going to do. So that kind of gets into some things that the last person I had on was Issy Roman, an economist, and talking about density. So as people are moving to these more affordable areas, if they don't tackle the density issue, meaning they need to add more density, then they're just going to become unaffordable. And then in 10 years from now, they're going to be not the hot place to be, because they'll cycle quicker. So they need to build more density, because you need people to be able to live and work in the same place. Yeah. Everybody can't, I lived in Boulder for a while, and that was an issue. They wouldn't allow any density. So everybody had to commute in, and then everything cost more because the workers had to drive an hour to get there. So there's just interesting dynamics that are happening right now all over. All right, let's switch gears a little bit, unless there's anything you want to add. But tell me a little bit. We've got a few minutes here. Tell me a little bit about where you came from, how you got to be, and then I'm interested to learn about some of the things you have on your desk back here.
Always lived in Washington, grew up on the other side of the state. Attended in Spokane specifically, which, by the way, happens to be one of those cities. Actually, I'll segue here just for a second, because I can't agree with you more. I saw a recent, and I'm sorry, I can't. I'd like to give credit for whoever published it, but typically, this time of year, or frankly throughout the year, there are those that prognosticate as to what the top 10 or 20 markets are going to be for any given year, and usually those top 10 lists consist of, most of the cities are in the top 50 MSAs, around the country. It's the Austins, the Denvers, the, so on and so forth.
Phoenixes, and yeah.
Exactly. And I saw a recent list of 10. Again, I cannot remember where I found it. And I think I might even be able to list all 10, but the cities that were noted: Spokane, Washington, Boise, Idaho, Longview, Washington, which many have probably never heard of, Eugene, Oregon, Phoenix, and one other city in Arizona. that is like, I want to say
Prescott.
maybe, what's that?
Prescott.
Yes, Prescott. That's right. Mm-hmm. That's right. Twin Falls, Idaho. So, interesting, Colorado Springs. Those markets, I think, will continue to be really, really attractive. They are very commutable, either by a relatively short car ride or a short flight away from a major airport and a major hub. And we are certainly seeing that today in some of our activities. So back to me. I grew up in Spokane, attended the University of Washington here in Seattle. Thought I was on my way to law school when I stumbled into the mortgage business, which happened as a result of not performing as well as I needed to on the entrance exam for law school, which meant I was going to have a year before I could reapply. And my father owned a Mercedes franchise in Spokane and suggested that I talk to a couple of his customers, and I found my way into the mortgage business. And literally overnight, I've just always loved the process of creating communities, home ownership, what it represents. It's part of the American dream. And like I said earlier, as we came upon the Great Recession, I've also always had an entrepreneurial itch. For the most part, early in my career, I scratched that by investing in other businesses and participating wherever I could provide value, and decided instead in the summer of 2008 to go do this and see if we could participate in helping fill the vacuum or the void that existed when the nation's largest banks all, left the space. Live now here in core Seattle, married 25 years. I've got a daughter who's been with the company for 4 years, just recently turned 25, and a son who will turn 22 in July, who is currently attending Washington State University. So, we've got the Apple Cup rivalry alive and well in my own household. We live walking distance from the University of Washington campus and stadium. So that's always a fun time. But yeah, some of the mementos that you see, were I not in the mortgage banking business, if you will, I wish I would have been a professional car driver racer. So back on my wall there is the first F1 event I attended a couple years ago in Austin, Texas, along with probably one of the highlights of the last decade in terms of things that I've done that were just truly entertaining, that were bucket list kind of items, was also the Indy 500, which I attended a year ago, Memorial Day. Up top there is a picture that you can't see of myself and George W. Bush, who I had an opportunity to meet at a conference that I spoke at a few years ago. University of Washington helmet that somebody has affectionately put a Mexican looking hat on, a signed football by Jake Locker, former quarterback for the University of Washington. And up there in the right hand, you can see it. It's kind of right above my head right now, is from the movie Castaway. That is the Tom Hanks. Wilson. And that is actually from the set of the movie. And how I ended up with it was my wife and I were at a charity event. We were down to 2 items. I had unsuccessfully bid 5 previous items. And so for $1,200 donation, I ended up with Wilson.
That's great. I have so many things that I've bought at auctions that we never use, like gift cards and horseback riding and whatever. So no, that's awesome. Thanks. Right. Well, you see my background. That's a picture of me when I was about 12 years old, ski racing, and some other skiing pictures. I'm a avid skier, ski racer, professional skier for a long time, and won just recently the Masters National Championship several years in a row.
Wow.
Part of that is I blew out my knee right after we talked or right before. Yeah, actually, it was right before we talked in March. And so I've been recovering from that. I'm also a rugby player. I play rugby. I've traveled all around the world doing those things, and it's great community people. And so I like to stay involved in that kind of stuff. Well, Kurt, I really appreciate you coming on. And it was a great conversation. We'll use some of this and make some content out of it. And I'll get you a copy of the recording. This is going on LinkedIn Live right now. We're currently live. It'll stay on LinkedIn. You can go and find where I tagged you when we went live, and you can share that out. People can rewatch the recording. Some good stuff. And, I try to put out some content every LinkedIn Live every week or every couple of weeks, and then some other content. So people have been following a lot of my commentary on the market, and most of it's me driving in my car with no notes and just spewing out whatever's on the top of my head. And it's funny because I tried to do some things where I sat in front of the camera, and hands down, everybody said they like the ones in the car, except for the people who don't like that I'm driving in a car, even though,
while you're doing that.
Well, I have it on a case, and I'm not like holding the phone and trying to drive. It's just, it's kind of like if you're talking on a speakerphone, but the camera's on. So anyway, well, we look forward to staying in touch, and hopefully we can do some business together here sometime and work together some. So
you bet. And Noel, thank you so much for inviting me on. I appreciate it. It's been fun to be involved, and likewise, I look forward to our continued growing relationship. So thank you.
Absolutely. Talk to you later. Thanks.
All right. Thanks.
Bye-bye.